Most people believe that when investing, the biggest risk is picking the wrong investment.
But in reality, it's usually how they react to normal market movement that causes the most damage.
Now, markets are designed to go up and down.
That volatility isn't a flaw, it's the price of admission for growth.
Today's episode is brought to you by Security Financial Management.
Robert Lovaglio here with Certified Financial Planner and Trevor Bell. Trevor, we hear this all the time. You know, there's a lot of anxiety that comes around with investing. Where is the differentiation there?
Yeah, it's funny you ask that, Rob, because people do oftentimes get emotions tied up to in investments, and it's very easy to.
It's emotional.
It's emotional, and it's your hard-earned money that you're trying to put to work, and it doesn't always work out that way, right? And actually, this is a great subject, and I'm excited to talk about it. And it's actually a financial theory, the loss aversion theory. And
interesting.
So we actually test for the loss aversion theory throughout our risk tolerance questionnaire because it is a very conceptual component to how we invest. But what the loss aversion theory states, Rob,
what exactly is that?
I'm
like a little over my head here.
let's dive into that. So what the loss aversion theory says is that people are more inclined to their losses than their wins. Okay?
Interesting.
And there's
They're
actually
more inclined to their losses than their wins.
Emotionally.
Right? You know what's funny is, don't I always say, in the office, I'm like, count your wins, not your losses.
Absolutely. Count the wins, not the losses.
Memo.
Yeah, you gotta appreciate the wins.
Yeah.
Because there's gonna be losses in the short term. But what we see with loss aversion theory is that people are a lot more attached to their losses. Just let's say for a numerical example, somebody is up 10% on a $100,000 portfolio, that means that they would be up $10,000, right?
Yeah.
And then in the next 3 months, it goes down 3%, and of that $10,000 profit, it's now down to $7,000. Somebody's going to be more inclined to be attached to say, hey, Trevor, calling us saying, hey, I'm down $3,000 versus, okay, well, you're actually up net $7,000.
Yes.
So
I think it's hilarious when I'm walking by one of the advisor's officers and we have a bad month or the market has a bad month in general.
Right.
It's like, man, I'm down 10%. And I'm looking, bro, you're up about 75% since you've been here 4 years ago.
Right.
What are you complaining about? You know what I mean? But I think to your point, it's it's in our human nature to dwell on the losses. And
right.
It's hard to just keep your head up. It's almost like in sports. Keep your head up. You missed a shot. If you're going to drill about it, then you're not going to perform.
And so there's a study out on Forbes about loss aversion theory.
I like this.
Yeah, no, and it was published by a CFP professional. Yeah. He was the author on it, and he actually talked about ways to combat loss aversion theory, which is everything that we've talked about for so long is having systems in place, having automation in place, whether it be dollar cost averaging into an account. It's a very, very interesting theory because it does tie to so many people, so many American people. Yeah. I'm glad that we're able to touch on it a bit today.
Right? Yeah, it's super interesting. Real quick for our viewers, will you just explain what the theory is again and just the basics of it?
Just to kind of wrap up the whole idea of loss aversion theory, it's oftentimes the emotional response that we have that pushes people to panic, second guess, or abandon good strategies at the worst possible time, right? You're essentially locking in losses, and in most cases, the portfolio didn't fail, but actually the reaction to volatility did.
And with that whole theory can kind of cause you to ultimately make mistakes in your portfolio is kind of what I'm hearing the theory is.
Right.
And how does that break down? Where's the break in that theory and the negative effect it can have on your portfolio?
Right, yeah, no, great question, Rob. So without clear goals and structure, investors are left reacting to headlines and account balances instead of following a sound strategy. And because these losses often feel heavier than gains, like we talked about, Rob, fear becomes the loudest voice in decision making, which is exactly where you don't want to be. And in fact, we often educate and embed in our clients' minds that you shouldn't be repetitively looking at your account, whether up or down, because at the end of the day, you've got a time horizon and you've got goals that you want to achieve that could be 10 to 15 years out. So why does the account balance today matter? And that's why people oftentimes stop contributing during downturns, Rob.
Both today and yesterday.
Move cash to after markets fall or constantly want to change strategies. Good financial plan doesn't try to eliminate emotion, Rob. The big thing is it anticipates the emotion. And it sets expectations ahead of time so short-term market noise doesn't derail the long-term growth that we could potentially have.
That's really how we provide value for our clients, and a big area that is looked over. You know, we say to our clients a lot, like, let us lose sleep over your retirement.
Correct.
You deserve it. You need to enjoy it. Let us lose sleep over those daily check-ins and daily market allocations and reallocating and everything in between. And as much as we say that, it's still, again, we are human. Right?
Yeah.
So like emotion's going to be involved.
Right.
And knowing that, how do you mitigate that to your clients, or like what is your advice on that, or how do you manage that?
Yeah, no, that's a great question, and it's a good way to kind of wrap up the point. And we've talked about it on previous episodes, but I can't stress it enough. But just having structure and automation and everything.
Yeah.
And so when you automate saving and investing and treat it like a bill, you remove the decision-making component of, hey, having to commit to, I don't know, $1,500 a month, $2,000 a month, whatever the number is. It takes the decision-making process out of like having to actually do it, because doing it is the hardest part.
It hurts a little more when you're writing down the check and you're handing it.
Absolutely. So when you automate it and it comes out like a bill, and it
Yeah.
kind of is like a seamless effort going into whether it be a cash account, high yield savings, or your investment account, just any type of automation and putting away is extremely helpful. And that brings me right into dollar cost averaging. If you're putting on a month-to-month basis into that investment account, you're capturing the ups, the downs, the sideways of the market, and everything in between. So again, automation. Instead of trying to time the market, you're consistently investing through it with dollar cost averaging. And ironically, the periods that feel the worst emotionally are often the most important ones to stay invested.
Yeah, those are the ones that are going to hit later
Right.
on, about 3-5 years.
That's when you see that account, up crazy numbers in a year, is when you're taking advantage of the downturns.
Discount. And on the opposite side of that was when you're like growing up, your parents, or at least my parents, were like, don't use your credit card, use cash, because you'll feel it. You'll feel when you pay for it. You know what I mean? Every time you pay for a sandwich, you're like, you feel that $10.
You might as well scrape some skin off you and
Let's get rid of that pain, man. Automate it, baby.
Automate it, absolutely. And honestly, Rob, that's how long-term success is built, not by predicting markets or options trading. It's by a design system that works even when emotions don't.
Beautiful. Well, if you want to talk to Trevor, any one of our certified financial planners here, we're going to leave a link in the description and a QR code right here. Remember, folks, the secret to wealth is not what you earn.
It's what you keep.
It's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.